Why the rich buy assets while others buy liabilities, understanding wealth accumulation through financial intelligence. Why do some people work their entire lives and retire with nothing, while others build generational wealth that compounds for decades? Why does a doctor earning $300,000 a year struggle with debt, while a janitor accumulates millions? Is it luck? Intelligence? Inheritance? The answer is simpler and more uncomfortable than you think. It comes down to one fundamental distinction that separates wealth builders from wealth consumers. The rich buy assets. Everyone else buys liabilities, and most people can't tell the difference. Today, we're breaking down this critical concept, not with motivational rhetoric, but with financial definitions, real numbers, and documented case studies. Because understanding this distinction is the difference between financial freedom and a lifetime of working for money. Welcome to today's lecture on wealth accumulation fundamentals. I'm going to explain the single most important concept in personal finance, the asset versus liability framework. Here's what we'll cover. First, we'll define what assets and liabilities actually are from an accounting perspective, not what marketing tells you, but what your balance sheet shows. Second, we'll analyze why most people unknowingly buy liabilities while believing they're making sound financial decisions. Third, we'll examine real case studies comparing spending patterns between wealth accumulators and high-income consumers. Fourth, we'll break down specific categories: real estate, vehicles, education, and consumer goods, showing you exactly where money flows in versus flows out. Finally, we'll provide a practical framework you can apply immediately to evaluate every financial decision you make. This is not theory. This is accounting. This is mathematics. And by the end of this lecture, you'll understand why your financial outcomes are determined not by how much you earn, but by what you do with what you earn. Let's begin with definitions. Defining assets and liabilities. Let's establish precise definitions, because confusion here is where most financial mistakes begin. An asset is anything that puts money in your pocket. A liability is anything that takes money out of your pocket. That's it. That's the distinction. Not how much something costs, not what society calls it, not how it makes you feel. The only question that matters, does this generate positive cash flow, or does it consume cash flow? Let's apply this to common purchases. Real estate example, you buy a house for $500,000. Is that an asset or liability? Most people say asset. They're wrong. If you live in that house, it costs you money every month. Mortgage payments, property taxes, insurance, maintenance, utilities, money flows out. That's a liability. But if you rent that same house to a tenant for $3,000 per month, and your total expenses are $2,500, you have $500 in positive cash flow. Money flows ein. That's an asset. Same house. Different cash flow direction, different classification. Vehicle example, you buy a $60,000 truck. Asset or liability? It depreciates immediately. It costs you insurance, fuel, maintenance, registration fees. Money flows out continuously. That's a liability. But if you use that truck for a business that generates revenue exceeding all vehicle expenses, it becomes an asset. The key principle, classification, isn't determined by the purchase price or the item itself. It's determined by the direction of cash flow. The rich understand this instinctively. They evaluate every purchase by asking, will this pay me, or will I pay for this? Most people never ask that question. They buy based on emotion, status, or cultural expectations. And they wonder why they can't build wealth despite earning good incomes. Why people buy liabilities? Let's examine the psychological and cultural factors that drive people toward liabilities. Factor 1. Confusing price with value. People believe expensive things are assets simply because they cost a lot. A luxury car, designer clothing, a large house in an upscale neighborhood. High price tags create the illusion of value, but value is measured by return on investment, not cost. A $40,000 watch that sits in your drawer generates zero return. A $4,000 dividend-paying stock generates passive income quarterly. One costs more, the other creates value. Factor 2. Status signaling. Humans are social creatures. We buy things to signal success to others. The problem? Most status purchases are liabilities. They consume cash to maintain an appearance of wealth rather than generate actual wealth. Research from Dr. Thomas Stanley's study of millionaires shows that 86% of luxury vehicle buyers are non-millionaires. They're high-income earners signaling status, not wealthy individuals building assets. Factor 3. Consumer debt normalization. Modern culture treats debt as a tool for lifestyle rather than a tool for investment. Car loans, credit cards, payment plans. These normalize the purchase of depreciating assets with borrowed money, paying interest to own something that loses value. This creates a double liability. The item itself costs money monthly, and you're paying interest on top of that cost. Factor 4. Financial illiteracy. Most people aren't taught to evaluate cash flow, they're taught to evaluate affordability. Can I make the monthly payment? That's the wrong question. The right question, will this generate more cash flow than it consumes? If the answer is no, you're buying a liability. And liabilities accumulate. They compound negatively. They create a cycle where you work harder to pay for things that don't pay you back. How the rich think differently. Let's contrast two individuals with identical incomes but different financial outcomes. Case study 1. High-income liability consumer meet John. Orthodontist. Earns $350,000 annually. Drives a $90,000 Mercedes. Lives in a $750,000 house with a $6,000 monthly mortgage. Owns a vacation property with a timeshare. Wears luxury brands. Takes expensive vacations. His monthly expenses, $12,000. His monthly savings rate, approximately 8%. His net worth at age 55, $400,000. Despite earning millions over his career, John has accumulated minimal wealth because every dollar earned was directed toward liabilities. His high income funded a high consumption lifestyle. Case study 2. Asset accumulator, meet Sarah, school teacher, earns $65,000 annually, drives a 10-year-old paid-off sedan, lives in a modest 3-bedroom house with a small mortgage. She purchased a second property 5 years ago, a duplex that generates $1,200 in monthly rental income after expenses. She invests 15% of her income into low-cost index funds. She avoids consumer debt entirely. She buys quality items that last, not status items that impress. Her monthly expenses, $2,800. Her monthly savings rate, 32%. Her net worth at age 55, $1.2 million. Sarah accumulated 3 times the wealth on 1/5 the income. Why? Because she consistently directed money toward assets while minimizing liabilities. The pattern? The rich don't necessarily earn more, though many do. What separates them is their allocation formula. They maximize the percentage of income that flows into cash flow positive investments. Warren Buffett, one of the wealthiest individuals in history, still lives in the house he bought in 1958 for $31,500. Not because he can't afford better, because that house is sufficient, and the money he didn't spend on a mansion was directed into assets that compounded for decades. The mathematical reality: wealth accumulation follows a simple formula. Wealth equals sign, income, liabilities, plus asset, appreciation. If you increase income but proportionally increase liabilities, wealth doesn't grow. If you maintain low liabilities and direct surplus income into appreciating assets, wealth compounds exponentially. Practical category analysis. Let's break down specific categories and how to evaluate them. Category 1. Real estate. Liability: primary residence you live in costs money monthly. Asset: rental property with positive cash flow, commercial real estate generating income, REITs paying dividends. Category 2. Vehicles. Liability: finance personal vehicles that depreciate. Asset: paid off work vehicles that generate business revenue exceeding expenses. Category 3. Education. Liability: student loans for degrees with low earning potential. Asset: education that increases earning capacity beyond the cost of tuition and generates positive lifetime ROI. Category 4. Investments. Liability: speculative purchases with no cash flow, collectibles, speculative crypto with no utility, precious metals held long term without appreciation. Asset: dividend stocks, bonds, index funds, businesses generating profit. Category 5. Consumer goods. Liability: almost everything, clothing, electronics, furniture, subscriptions. Exception: tools or equipment that enable income generation. The evaluation framework: before any purchase, ask 3 questions. Question 1. Will this generate cash flow or consume it? Question 2. If it consumes cash flow, is it necessary for survival or income generation? Question 3. Can I acquire an asset instead of this liability with the same money? If something generates cash flow, it's an investment. If it's necessary for survival, it's an expense. If it's neither, it's a luxury, and luxuries should only be purchased after you've built sufficient assets to cover them. The compounding effect. Here's where mathematics becomes powerful. Let's compare two 30-year-olds over 25 years. Person A directs $500 monthly into liabilities, car payments, finance furniture, consumer debt interest. Total spent over 25 years, $150,000. Ending value, 0. Those purchases depreciated or were consumed. Person B directs $500 monthly into assets, low-cost index funds, averaging 7% annual return. Total contributed over 25 years, $150,000. Ending value, $406,000. Same money, same time frame. One person spent it, one person invested it. The difference? $256,000 in wealth creation. And that's conservative. If person B also avoided debt interest, maintained a higher savings rate, and reinvested dividends, that number could exceed $600,000. This is the power of asset accumulation. Not getting rich quick, not finding a secret investment. Simply directing money toward things that generate return instead of things that generate expense. The rich understand this. They delay gratification. They live below their means not because they have to, but because they recognize that every dollar spent on liabilities is a dollar that can't compound into wealth. Let's summarize the core principles. Principle 1. Cash flow determines classification assets. Put money in your pocket. Liabilities take money out. Every purchase falls into one of these categories. Evaluate accordingly. Principle 2. Income doesn't equal wealth. High earners who buy liabilities accumulate less wealth than modest earners who buy assets. It's not what you make, it's what you keep and what you grow. Principle 3. Delayed gratification compounds. The rich delay consumption to accelerate investment. The money saved on unnecessary liabilities is redirected into assets that generate passive income. Over time, those assets fund the lifestyle without depleting principal. Principle 4. Systems beat willpower. Don't rely on discipline alone. Build systems that automate asset accumulation, automatic investment contributions, automatic savings transfers, automatic debt payoff schedules. Make wealth building the default, not the exception. Application starting today. Review your current spending. Categorize every expense as asset, necessary expense, or liability. Calculate what percentage of your income flows into each category. If more than 50% goes to liabilities, you're on the consumer path. If more than 20% goes to assets, you're on the wealth building path. Your goal, incrementally shift the ratio. Each month, direct 1% more toward assets and 1% less toward liabilities. Over 5 years, that shift becomes transformational. Final thoughts. The rich don't have a secret. They're not smarter, they're not luckier, they simply understand one fundamental truth that most people ignore. Wealth is built by accumulating things that pay you, not things that cost you. You already know this now. The question is, what will you do with this knowledge? Will you continue buying liabilities because they feel good, look impressive, or seem normal? Or will you start buying assets because they generate wealth, create freedom, and compound over time? The choice is yours. The mathematics don't lie, and the outcomes are predictable. Class dismissed.